Over the last 2 episodes, we were able to learn whether BrightLeaf earned a profit during 2026 by looking through the income statement, the first of 4 financial statements we'll cover. And it did. BrightLeaf earned net income of $98,320 in 2026. And while that's very useful information, it does have its limits. It only tells us what happened over a period of time. It conveys no information about what exactly BrightLeaf is. What does this company own? What does it owe to others? What is it worth? While net income is an important data point when trying to place a value on a business, that $98,320 looks very different depending on the financial position of the company. It may be a very impressive result, or it may not be. And to decide that, we need to continue our journey and turn to a second lens through which to look at the business, the balance sheet. So in this episode, we'll dive into the balance sheet, and along the way we'll start to see the first real connection between 2 of our financial statements. So just like the income statement, we'll start by going through the high-level organization of the report, and then turn to BrightLeaf so we can bring everything to life with real numbers. At the highest level, the balance sheet is organized into 3 sections. At the top, you'll find the company's assets, everything it owns. Then below that, the company's liabilities, everything it owes to others. And finally, at the bottom, the stockholders or shareholders' equity, which is what's left for the company's owners after you subtract everything that's owed as a liability from everything that's owned as an asset. And that organization is worth pausing on. Note that idea again. The final section, the shareholders' equity, is equal to what's left after we subtract our liabilities from our assets. And that equation, the fact that a company's assets equals its liabilities plus its equity, is the most fundamental equation in all of accounting. Now, we won't get into a deep discussion around debits and credits and dual entry accounting here, but again, at any point in time, a company's assets are equal to its liabilities plus its shareholders' equity. And when it comes to reading the balance sheet, this has an important implication. It means that for every asset a business owns, the funding for that asset had to come from one of 2 possible sources. Either someone lent it money, which is a liability, or the owners of the business provided it, which is equity. There is no third option. Every dollar of assets the company owns was funded either by borrowing or from the company's owners. So this idea that assets equals liabilities plus equity isn't an accounting or mathematical trick. It's simply a natural outcome of the idea that all the assets a company accumulates must be funded through either a liability or owner's equity. So with that in mind, I do want to press home one more idea before we turn to real numbers. We covered it in passing, but it's worth highlighting. The balance sheet is a report that presents information at a single point in time. This is in contrast to the income statement, which shows activity over a period of time. So while we looked at BrightLeaf's income statement for the year 2026, anytime we look at the balance sheet, it will be at a point in time. Maybe December 31st, 2025, or December 31st, 2026. Most often, we'll be interested in a balance sheet at the end of a period, and possibly compare it to a balance sheet at the end of the prior period. So keep that in mind, and it'll become more obvious as we look at BrightLeaf. And speaking of, here's the balance sheet for BrightLeaf. You'll notice we've included 2 periods, the information as of December 31st, 2025, the end of last year, and December 31st, 2026, the end of the period covered by the income statement we looked at last episode. And this is common when analyzing a balance sheet. We're often just as interested in the change in the financial position from one period to another as we are in the financial position as of today. So let's first walk through the organization, focused on the figures as of December 31st, 2026, and then we'll circle back and think a bit about how they connect to the income statement. As we learn, the first section at the top is the company's assets, and you'll see this is further broken down into subsections for current assets and non-current assets. Current assets include cash along with assets that will either turn to cash or be used up within about a year. So these are the short-term items. Think things like accounts receivable, inventory, and prepaid expenses. You could see as of December 31st, 2026, BrightLeaf had $159,163 of cash on hand, $5,000 in accounts receivable, $17,000 of inventory, and $6,000 in prepaid expenses. The accounts receivable would be for a customer to which we provided service but have yet to be paid, maybe a client we did some catering for. The inventory would be the cost of beans or other supplies we have on hand to serve coffee and pastries. And the $6,000 in prepaid expenses will be for things we've paid for but not yet used up. This could be something like our insurance, which will typically have to be paid up front, but then cover us for a period of time. Then you'll typically see a total on the balance sheet for current assets. And as we can see, BrightLeaf owns a total of $187,163. Then after current assets, we'll see a subsection for non-current assets. These are the long-term items the business uses to operate, things like equipment, furniture and fixtures, or even buildings. If a company has intangible assets or any other long-term assets like prepaid expenses far longer than a year, those will also appear here. We'll avoid diving into intangibles or other items here to stay focused on learning the balance sheet. But you can see BrightLeaf does have some fixed assets they use to operate their coffee shop. Their categories are equipment, which will be things like their espresso machines and grinders totaling $77,000, and furniture, which would include the tables, chairs, and other items for customers to sit at, totaling $41,800. Then they also own the building they're doing business in, which they purchased for $500,000. And you'll notice that all of these fixed asset categories are broken into two accounts: the primary account and an accumulated depreciation account. The first account in each category will show the original cost of the equipment, while the accumulated depreciation will reflect how much of the asset has been used up and recorded as depreciation expense. We'll circle back to that as we discuss the connection between the income statement and balance sheet. For now, note that BrightLeaf's total accumulated depreciation is $54,180, so the total book value of the company's fixed assets is $564,620, leaving us with total assets, current and non-current, of $751,783. That's everything the business owns. So I think that's a good stopping point for this episode. In the next, we'll come back and turn to the company's liabilities and shareholders' equity so we could see exactly how it funded these assets.